Hey everybody, how we doing? Hey, so the last couple of days I've been having some conversations online about when is a good time to consider breaking your fixed mortgage. Obviously, interest rates are going up at the moment, so there's a lot of people looking at it going, is it better to break now and take whatever rate is available now versus breaking it or letting it roll out to the end of its fixed period and breaking it later and handling whatever interest rate we might be at later that may be higher. So there's a few considerations there, and I've tried to cover some of them, but let's bear in mind that this is not financial advice and it's not advice for any one person. It's very general advice based on a whole lot of really random considerations. One of them being that if you break your rate to go to a lower rate, in essence, you will probably have to pay a break fee. So the calculation actually becomes really quite easy. It's what is the break fee versus what's the new rate that you might end up on. The next one is if you break and go to a higher rate, what's the cost today versus the break fee versus the possible future rate when you come off that new broken rate. So that becomes three randoms, which becomes a little bit more complicated. There's a calculation you can go down through though. An example might be, if you have a $400,000 loan at 4% and it takes 20 years to pay it off at $2,424 per month, but you're switching to a rate at 3%, i.e. the interest rate's going down, which is not the current market, but if the interest rate's going from 3 to 4% over a 20-year period, you will save yourself 2 years and you'll save yourself about $65,500 interest. But interest rates aren't going down at the moment, they're going up. So let's look at a few interest rates going up and breaking our rate considerations. So let's consider this as a starting position. We've got a mortgage at $750,000 at 3.79% over 30 years, and we're paying $3,490 per month. We're fixed for another 8 months, for instance. This actually means that we're paying 1.6 times the principal in total repayments, by the way. If we break that now, we've then got $750,000 at, say, 6% over 30 years. We're paying $4,497 per month, which costs us another $1,007 per month, or $8,000 over the next 12 months. But you're also then paying 2.16 times the principal figure. Now, I figured that out on this, which is the sorted.org.nz website. Another interesting website to use is interest.co.nz. They've actually got a break fee calculator if that's a consideration. But for the following numbers, what I've used is the home loan interest rates based on KiwiBank. So that gives you an idea of the rates that I've used. Now, if we use this scenario, for instance, $750,000 at 3.79 fixed for the next 8 months, and we choose to keep that interest rate and then go to a floating rate at 7%, then in the next 12 months, we're going to have the situation where for 8 of those 12 months, we're paying the 3.79 rate, $3,490, and that's going to cost us $27,920. We're then going to let it go to a floating rate. My expectation is the floating rate will then be at 7%. Now that's a guess, obviously. So that's going to cost us $4,990 for the last 4 of these 12 months. So the first 8 months are going to cost us $27,000. The last 4 months will cost us $19,960. So that total cost over 12 months is going to be $47,880 in interest and principal costs. And this is what we're going to consider our benchmark to be if we compare that with doing it any other way. Now, another way that we could do it is to keep the existing interest rate and then refix. Now, what we've had to consider then is that over the 12 months, we've got to do the same $3,490 for the first 8 months, costing us $27,920. And then if we refix for another 12 months, the last 4 months are going to cost us $4,618. I'm estimating at 6.25%. Once again, that's an estimate. And so Once again, same as the first example, the first 8 months are going to cost us $27,920. The last 4 months at 6.25% are going to cost us $18,472. So slightly less than the other example. So obviously fixing it's going to give us some guarantee over floating. So instead of the benchmark at $47,880, it's going to cost us $46,392, giving us essentially a $1,488 saving. So if we look at that as keep and float versus keep and refix is kind of winning, if you like, at that rate. Another consideration, break it and refix it straight away. So that might cost us, say, 7.5%. But what we're then going to have is 1 year at $4,444 times 12, giving us $53,328. So this actually costs us $5,448 over our benchmark figure. So once again, interesting consideration. Benchmark, $1,400 saving, $5,500 cost. So why don't we consider keeping the existing rate for the next 8 months and refixing at that point for a 12-month term at 7.5%. So then the first 8 months cost us the standard $27,000. The last 4 months actually cost us $5,244 per month, which is $20,976, which means that total cost is going to be $48,000, which is going to cost us an additional $1,016. So I think what you get from that is, and I keep saying this in the comments section where people ask me, when they say to me, should I break my mortgage or should I leave it rolling? What I'm saying is do the math. This is the math. It's quite complicated. There's a lot of it. There's a lot of considerations to be had, and only some of it's set in stone, meaning only some of it you can know right now. You can know and ask your bank, for instance, what the break fee might be and what the interest rate that they could put you on to now might be. If you're within 30 to 60 days of your fee breaking, you might be able to refix straight away. The rest of it comes into grey areas and assumptions. Assumptions of not only what the break fee might be if you don't ask the question, but also what the interest rate might be in future. And I think that becomes realistically the really big question is not what are my costs now, but what could they be in future? And all of these numbers only predicate fixing for another 12 months. Obviously you have the option of fixing for between 12 months or just leaving it floating, or also fixing it for 2, 3, 4, or 5 years as well. And obviously the further out you go, the more vague it becomes because you don't know what the prevailing interest rate might be at that time. Now, we all tend to be fairly terrified about fixing for 5% and then having it drop to 4%, but you also have the security of knowing you're at 5%, not at 6 or 7 or 8%. And it's worth obviously noting that the 25-year average for interest rates fixed in New Zealand is 7.25%. So anything under that, you're kind of winning on the average, plus you have that security. I can't tell you exactly what to do. All I can say is you can do all of these numbers and you can get a fairly good idea of where it's going to go. Additionally, you can look at the floating rate, the 1, 2, 3, 4, and 5-year interest rates, and that creates a graph. At the moment, that graph goes up, meaning that the 12-month rate is lower than the 5-year rate, and that's because banks and bank economists believe that interest rates are going to continue to go up. My advice is do the math, do the numbers, and also talk to your mortgage broker, because they will also be able to help you with unconventional ways of thinking about it, such as leaving some floating, breaking some, fixing some, also taking, say, a $500,000 mortgage and cutting it up into two $250,000 mortgages, fixing one for 2 years, one for 3. It all just depends on your individual situation as well. So call your broker, take some advice, and do the math. That's a really long video from me. Hope it was useful or interesting to you. If you need to slow down, you can look over these notes and numbers that I've made, but hopefully it gives you an idea of how I think about these things, and basically that I don't try to leave too much to chance. In essence, I do the numbers and do the math and figure out the most likely thing to happen. Hope that was useful today. Have a great day and see you tomorrow.